Welcome everyone to today's session. So it's all about home buying. Lot to pack in today's session. So yeah, get your pens and paper at the ready for noting down anything that we may discuss today, any signposting. So make sure you're ready to do that. Just a little bit about myself. My name is Nadine Mennels, has already been introduced. Sorry. I'm a financial wellbeing consultant at Better with Money, and we're an independent provider of financial education. So we provide webinars like these to help bring money matters to life, to reduce money stress and any financial anxiety you may be feeling right now, and mainly to help you build some financial resilience. And I'm going to be your presenter today. So just a little housekeeping points to cover. First of all, today's session is providing information only, so I won't be providing any sort of financial advice. Better with Money has no financial products to sell. So where we do mention companies or organisations along the way, it's because we genuinely believe that they offer good services and that you can take advantage of that, and that not because we've got any financial incentive to do so. Finally, as Fiona already mentioned, the session is being recorded and there will be time for Q&A at the end. So what are we going to be looking at today? So here's the agenda. So the stages you go through when you buy a home, how to prepare financially by budgeting and improving your credit score. We're going to look at the costs associated with buying a house before covering the different types of mortgages and the process for remortgaging if you're in that position. And then we'll finish with that Q&A that's already been mentioned. Okay, it's good to actually start off with a few statistics. So according to the Money Charity, the average house price in January of this year was almost £300,000 throughout the UK. Thinking about the average house price for first-time buyers, that was 226,744 in December 2024, which represents an annual increase of 4.7. And also, apparently, it takes an average of 11 years to save a deposit. So if you save the average rate, but out of the average UK income, so that's how long it's going to take you. It's a long time, that, isn't it? And of people applying for mortgages, more than half managed to borrow money on a mortgage that was more than 3 times their annual income. The home buying and mortgage markets are constantly changing, and we've seen quite a few base rate cuts, in the last few months and years, and we've just had one this week, haven't we? Well, just the back end of last week. So, that's going to have further impacts on the statistics. And I know I've just mentioned to Fiona earlier that I'm in the middle of the home buying process, and from applying for my mortgage and having it, having it rubber stamped, there's actually been 3 dips in my mortgage rate, so it's getting cheaper and cheaper by the week. So that's absolutely brilliant on my part. So hopefully in the next week my mortgage lender will be dropping the rates again. So again, it's a constantly changing market. Now let's move on to look at the stages of home buying, because it can get a little confusing. It can be a little bit, well, what comes before this, and should I be getting this at this stage, and when should I be doing these things? Being aware of these stages early on is important. So we are going to look at the process for buying a house in England and Wales, because it can be quite different in the other territories. So we're just going to concentrate on England and Wales in this webinar. The first step is working out what you can afford. Online mortgage calculators can be a really good place to start to give you a rough indication. And there's also mortgage affordability calculators as well on our website and our Better with Money website if you want to look on there. However, ultimately, you will probably want to approach a mortgage advisor who knows the market and what providers are likely to lend you. And sometimes they can take a little bit of the legwork and the uncertainty out of the process. What they'll do is they'll ask you for details like your salary, any other income you receive, the amount of your deposit, and also your expenditure, including things like council tax and car finance. They will go through your finances with a fine-tooth comb. They want evidence of these as well. So pay slips to show your salary, bank statements, showing your expenditure, and evidence of your savings too. So they want to see that you have got that deposit ready to go. Then they'll look at mortgages available on the market and see what you might be accepted for. If you don't have friends or family that can recommend a mortgage advisor, have a look on the website unbiased.co.uk. Most mortgage advisors will only charge you a fee if they arrange a mortgage for you, not for the initial discussion. But they may be able to help you obtain a mortgage in principle, which is also known as, it's either called a mortgage in principle or a decision in principle, or it also can be called an agreement in principle. Essentially, this is an official statement or estimate from a lender of how much you may be able to afford to borrow ahead of making any offers on properties. And a lot of estate agents will want to see that document to assess that you are a serious buyer and that any offer you make is realistic. So when you do start looking at properties, it is important to get that decision in principle or agreement in principle first. And then you can go in and they know you're a serious contender when you're putting in offers. Next step is to find a property, which means doing your research in terms of areas, properties that meet your needs and your criteria. And you could contact, local estate agents, or nowadays, most of us just look on Rightmove from the comfort of our own sofa. I know a lot of my friends, they've been in their houses for years and they still do a nightly look on Rightmove to see what's in the area. It could become a little bit of an obsession, even when you're not ready to move or look for another house. Now, if you do find something you like, you can arrange a viewing with the agent. Although, again, some agents do virtual tours too. You may wish to have a list of important questions to ask the seller or agent during your viewings. Once you find the property you like, you can then put an offer in. Your offer may be lower than the asking price, but the seller is well within their rights to turn that down and only take offers which are at least asking price. But just like anything, it can be worth a go at handling and get a reduction. If your offer is accepted, then you'll need to arrange a solicitor. So they can either be a solicitor or when it's somebody specifically doing it for a property, it's a conveyancer. Now that person will do searches on the property, such as making sure it's not in a flood area or hazardous site, and they will liaise with the sellers solicitors to get the contracts done. So that's their job. Between each of the solicitors, the seller solicitors and you as the buyer, they're the ones who, get all those legal bits and bats done. Your mortgage company will then ask for a survey to be done on the house. So that's like a valuation survey to make sure the house is worth what you're paying for it and if there are any problems that come back. So, the valuations done on the property, that's for the mortgage lender. That's to make sure that if for any reason the house was repossessed, that they would be able to get their money back as the lender on that property. Then there's something else that can be done. You can then request for a survey to be done. You pay for that. So there's different types of surveys. There's level 1, level 2, and level 3 surveys. So that's for you to actually organise and pay for yourself. And that is when any problems like leaking roofs or damps or any other issues, asbestos, troubles with the gas and electric, all those things are highlighted. And then if there are any issues with the property, you can go back and maybe renegotiate the price at that point. So, for example, if you got a survey done on the house and it come back that there was roof problems, then it's a good idea to get some quotes from builders to go and see what it would cost to get that fixed. If the builder comes back and says it's going to cost £5,000, you need a brand new roof, then that's when you can go back to the vendor, the seller, and say, look, this is what it's going to cost. Are you up for negotiating and reducing the price? Because, we've got to recoup the cost somewhere. But assuming there are no problems, the offer and the mortgage are finalised and the contracts are drawn up. Once the contracts are agreed, you exchange, which is the point that the deal becomes legally binding. And usually pay about 10% of the house price. You can have a 5% deposit if you wish. And at that point to the sellers, which your solicitor will arrange. So they'll guide you through that process when you need to transfer monies. You will also arrange a completion date, which is usually around 2 weeks later, to give you time to arrange removals. And completion is when the remaining money is paid over and the keys become yours. The solicitor will liaise with your mortgage company to make sure that the funds are released at the right time. The whole home buying process can take anywhere from around 3 months to a year. I know some have taken longer than that, and in some horror stories. Depending on how long it takes, you get a mortgage agreed and how long it takes you to find a house you want, and then the time it takes to agree contracts and get the paperwork done. And you'll also hear about chains as well. So it depends on how many houses are in the chain, what's the starting point, what's the end point. So, all these variants can make the process quite lengthy. As I mentioned earlier, the home buying process does differ in Northern Ireland and Scotland. For example, buyers in Scotland have to put blind bids on a property. So it's really important to be familiar with those processes if you're looking to buy outside England and Wales. There's a great section on Money Helper website all around buying homes in different countries, as well as which is worth looking at if you're thinking of doing that. So that's home buying process in a nutshell. Them are the stages, but there are a few other steps which you may wish to consider to prepare financially. And knowing your budget is really a key part of this. That's because unless you are looking to switch rates with your current lender, the chances that you'll need to pass an affordability test in order to secure a new mortgage. First of all, let's consider what an affordability test actually is. In short, it's a calculation conducted by the lender to prove that you can afford to pay for your mortgage. Not only do affordability tests consider whether you can afford mortgage payments on day one, but they'll also look into the future to confirm that you'll continue to be able to afford the mortgage in the future if rates happen to increase significantly. Now, that's exactly what we've seen over the past few years. So since 2021, we've seen the Bank of England base rate go from 0.1 to 5.25 at its peak, and the mortgage rates have also increased significantly. So you've probably heard stories where people's previously had low fixed rate mortgage of say 2%. I know someone who was on 1.9. And then when they had to remortgage with the new rates of 5 or 6%, that's when they faced the mortgage payments each month nearly tripling. Clearly, this can result in a huge financial stress because monthly payments will also go up significantly when these rate changes happen. Therefore, it is a job of a responsible mortgage lender to ensure that individuals can continue to afford their mortgage payments, even if the rates go up. So with that in mind, let's just look just quite quickly about preparing a budget so that you're doing everything you can to maximise the likelihood that you pass the affordability test and you can show the new lender that you can afford the mortgage you want. Ultimately, the thing to do is prepare your budget. So, let's go through a few points on the slide. So the first point refers to your monthly budget. It's vital you are keeping on top of this, particularly in the months running up to your mortgage application. You have to be the perfect, ideal customer in those months running up to it. So it means getting a handle on your income. What do you receive each month after tax? Your expenditure, what are you spending each month? Quite simply, you need to be spending less than you earn. We do have some free monthly and annual planners on the Best With Money website that you can print off and complete. And we also have an online interactive budget planner too. Having completed your budget, try and be honest with yourself, see if there are any areas you could save money on. Like, do you spend lots on food and takeaways or eating out? Could you cut back on these on that run up to doing your application? Take a look through your bank statements to help you with this. Go through your bank statement line by line and see what's your biggest outlay and could you cut those costs. The next point is very important. Please avoid taking any other debt, such as overdrafts, credits, or loans on the run up to applying for a mortgage, as the lender will want to see you can manage your finances on your income only and that you don't have too much recent credit. Ultimately, this exercise is about proving to the lender that you are able to afford the mortgage payments. And as we've already said, you need to provide evidence to support this. And remember, as I mentioned at the beginning of the slide, this isn't just about proving what you can afford, that you can afford the mortgage on day one. It's also proving that you can still be able to afford it if interest rates rise or costs increase. Okay, so the next thing to do in the months before applying for your mortgage is to check your credit score and work on improving it. It's so important that you've got a handle on your credit score because this is what they're going to be looking at to make a decision on whether you are a viable candidate to have a mortgage. So they're looking that you are an ideal customer. So everybody's ideal customer is different. Halifax's ideal customer is different to HSBC's customer. HSBC customer is different to maybe Nationwide's customer. So you'll never know what they're actually looking for. But if you can get yourself in the best place possible through your credit score, then you'll be in a good place. So when you do apply for a mortgage, lenders run a credit check on you. They look at your financial history for all your accounts during the last 6 years. They'll be looking to see that you're a responsible borrower and that you haven't missed any payments on credit cards or loans. If you have, then it might suggest that you do the same on your mortgage and you're less likely to be approved. Now, there are 3 credit reference companies in the UK. You've got TransUnion, Equifax and Experian. If you go direct to those companies, they will charge you for your credit score. So the best way to access this information is by downloading Credit Karma. So Credit Karma is TransUnion. It's the free of charge app for TransUnion. ClearScore is Equifax, so download that one. And Experian is just Experian, get the free of charge version. Each service does use a slightly different scoring range, but the important thing is which category you fall into. It will be indicated on the report as either excellent, good, fair, maybe poor, needs improving, something along that language. And it will also tell you the colour, so it'll go from red through to amber, yellow, green, and then bright green. And it'll say it in a number as well. So 0 to 700 for Credit Karma, 0 to 1,000 for ClearScore, and 0 to 999 with Experian. So the higher your score, brighter the green the colour, the better the word, you're heading for that excellent, that's the brackets you want to be in. You should be looking at this credit score at least 6 months, 6 to 12 months before you're planning on buying a house, because if you're not in the best place possible, then you've got time to improve your credit score. Because having a better credit score gives you the chance of getting the better rates. You get the pick of the bunch of the products. You know, they're gonna look at that and they're gonna think that's a brilliant customer. That individual is a safe bet to lend to. Yes, we will give you the money. So yeah, it's really important that you make sure that your credit score is as good as Nick as it can be. So a few things to do to improve your credit score. And when you do go on these apps, they will give you hints and tips of what you need to do for your personal situation and to improve your score. So take on that guidance that is on the app. But things like paying your bills on time, don't miss payments, pay them on time, don't pay late either with these. Use less than 20% of your credit limit if you've got credit cards, because that shows that you're not reliant on that credit card. Register on the electoral roll. So wherever you're living now, register on the electoral roll. That can bump up your score significantly, because that's used as an ID check as well. So it verifies your ID. So they do that through your credit scores. So a couple of things there to make sure you're in the best place possible going forward. Now, I just want to touch on home buying costs, because aside from the mortgage and the deposit, we find quite frequently that people often fail to account for the additional fees associated with the home buying process. So you might have saved up for your deposit and think absolutely brilliant, but what I would say is you need a contingency fund. You need at least between 3, 4, 5 grand saved up apart from your deposit to cover a lot of these fees, because they're going to be coming at you hand over fist for money. And like I said, I'm in this situation now. So I've had to pay for a survey. I've had to pay the deposit for the initial deposit for the conveyancer. I've had to pay out for other arrangement fees for my mortgage. I've had to pay for my mortgage advisor. And if that money is there ready to go, then you're not stalling the process. You're keeping the wheels turning. So again, don't just think of your deposit. You need a few grand in a contingency fund so that you can just pay out these extra things as and when they come in, and you're not delaying it. So, if you are selling a property, then there's the extra cost of, estate agent fees. So depending on what your estate agent you can go from, there can be different percentage of selling prices. Again, you've got your legal fees. So depending on who you go with for your conveyancing, or if you go with a solicitor, they're going to have legal fees, and they want an initial deposit before they then want the balance later down the line. Mortgage arrangement fee. So sometimes when you go for a mortgage with a particular lender, they might charge you a fee to book in a lower rate. So just account for that if you want to do that. A lot of mortgages don't have arrangement fees, but if you want to book in a lower rate, then you might pay an extra fee for that. You got your valuation fee from your mortgage as well. So there'll be a fee between 150 and sometimes up to 1.5 grand, for that. That's through the mortgage company. And then you've got the survey that you will request to do. You don't have to have this done, but obviously on your head be it if you move in and then in the next week that you've moved in, the roof falls in. There are things, the surveys you can have done to be prepared for that. You got your stamp duty. And then it'll be land and building transaction tax in Scotland. You've got moving fees as well, depending on where you're moving from or moving to. Them can be a significant cost. I remember years ago, I moved from Essex back to the northwest, And I think that's cost nearly, I think it was about a 1.5 grand that to bring me up. And that was years ago, that was 10 years ago. So, you know, you've got to factor that in. If you're moving just around the corner, it might be a couple of hours, 2 men with a van, and it's going to cost you 100 quid. You never know. And then you've got to account for your life, house, and contents insurance. I just had a meeting with the insurance lady, and I've been told that my policy is going to be £85 a month. And that's money I just didn't really think about. So yeah, that's a commitment to pay that every month now for my life insurance. I had a policy in place, but it's not fit for purpose for the new property. So yeah, an additional policy has had to be got. And then I've got to think about buildings and contents once, you know, I get a little bit further down the line and need to get those as well. So a lot to think about there that we probably didn't have a look at. Right, types of mortgage. So just going to whiz through these. So these are the types of mortgage that you can get. So, you know, it's like any loan, a mortgage company will lend you money and you pay that back with interest over an agreed period of time. You can apply for a mortgage by yourself or jointly with someone. If it's jointly, then both your finances will be taken into account when looking at affordability. And this includes your joint income and also both of your expenditure. So, right, let's go on to the first one, fixed rate. So fixed rate, this is where the mortgage company fixes the interest you are paying on a mortgage for a period of time. So you take a mortgage out over 25, 30, you can even take them out over 40 years now. But those years are broken down into what you could say deals. So you will get a fixed rate mortgage with a mortgage company, say nationwide, and then you fix it in for 2, 3, 5, or sometimes you can fix them in for 10 years. And then you've got that advantage that you've got peace of mind as to how much you have to pay each month. So that's when you pay off the capital and you pay off the interest as well. So that's that fixed rate. You know where you're at for the next 2, 3, or 5 years, or maybe 10 if you go for that one. And it's guaranteed every month what you're paying. When your deal ends, that's when you should be looking for your next fixed rate deal. So, you know, it's always good about 3 months before your deal comes to an end to be looking then to move on to another deal and not going on the standard variable rate, which I'll speak about in a minute. Next one is a tracker. So a tracker mortgage, they track the Bank of England base rate plus a percentage amount set by the lender. So say your mortgage was at 1% above the Bank of England base rate, then you will be paying, you know, 1% above that. So if the Bank of England base rate goes up or down, then your tracker rate will move in the same direction. It can make budgeting a little bit difficult, as you can be a little bit uncertain how much you'll be paying each month because your payments can change. So, you know, it depends. If you've got the wiggle room to be able to, you know, take on a tracker mortgage, then absolutely fine. Standard variable rate. So this is the mortgage lender sets the rate and it could go up or down with at any time with any notice. So usually the standard variable rate is what you go on to after you've finished a fixed rate or a tracker or anything like that. So in most circumstances, it can be significantly higher than the fixed rate or the tracker, or so it's not something you want to sit in for a long time. You're not tied to any contract, so there is a flexibility to move on to different deals without incurring any penalties on that. And sometimes people sit in the standard variable rate if they're planning on paying the mortgage off. You're not paying massive chunks off the mortgage because you don't incur any fees then. So, you know, you don't want to be sat in it just in not under normal circumstances. Discounted variable rate. So this is where you get a discount on the lender's standard variable rate for a set period of time. And the rate is still variable, so it can move up and down in line with the lender's rates despite the discount. An offset, you probably heard about offset. A couple of banks do this. So if you have savings and a mortgage with the same lender, your cash savings are then reduced or offset to the amount of mortgage interest you charge. So you can look at Rightmove for more information about the different types of mortgage if you want to drill down on them. Okay, so brings us nicely on to looking at reviewing your mortgage. So it's important to do this periodically, and review your mortgaging may mean remortgaging. So remortgaging simply means switching your existing mortgage to another mortgage, whether with your current provider or a brand new one. Done right, remortgaging may help you get a deal that's better suited to your current circumstances. So there's a few reasons why you might want to remortgage. So your current deal is ending, which we've just spoke about. So you're coming out of a fixed rate deal. So you've got to look for your next deal. You might have found a better deal elsewhere. So there's lower rates. You might be worried about interest rates. So, you want to fix in for another period of time and just get that certainty. You might want to borrow more money. So you might want to do home improvements, or you need to release some equity. Maybe your home value skyrocketed. If your loan to value has gone up, then you might get a better rate because you've got more equity in your property to lend against. And you might want added flexibility. So some products, give you certain flexibilities that others don't. So that's the reasons why. You shouldn't be thinking about remortgaging if your current deal has a huge repayment charge. You must check out the fees and associated costs of coming out of deals early. The alternative rates aren't much better than your current deal. If you're suffering from financial difficulties or credit problems, like we said, it's really important that your credit score's good when you're going into mortgage applications. If you're in a situation where it's not good, then it might not be a good time to be making those applications. If you recently changed jobs, a lot of mortgage companies like to be in your job for at least 3 to 6 months and be on permanent contracts when you apply for mortgages. And if your home's dropped in value, which we call negative equity, that can affect that as well. Right, just want to whip through the stages of remortgaging. I'm just aware of the time, so I'm just going to whip through this. So you need to work out, if you're going to remortgage, work out the cost of leaving your existing lender, whether there's any fees or penalties. Find out how much your property is worth, so you need to get a valuation on that. Then speak with a mortgage advisor if you choose to, and find out what the best deals are at the moment for your situation, because your loan to value might have changed, so you might be in a better position. Apply for a mortgage. You receive the mortgage offer documents, then you get the valuation and legal paperwork, sign the legal documentation, and your mortgage is now with the new provider. Now, what I will say quickly on this one is if you have a mortgage, say, with Halifax, and then you just want to stay with the Halifax and get a new deal with Halifax, that's called a rate change. So you won't have to do the full-on application process for that because you're staying with the same company. If you was with the Halifax, but then Nationwide was given a better deal, then Nationwide will treat you as a brand new customer, and you will have to go through full affordability, full mortgage application, full ID checks. You are treated like a brand new customer. So just be aware of that. If you stay with the same provider, it's a rate change and there's not much paperwork to deal with. If you go to a new provider, then you kind of start from scratch because you are brand new to them. They have to know who you are and prove who you are. Right then, quickly, useful tools. I'm going to whip through these. So you got your Money Supermarket mortgage guys, Rightmove house viewing checklist. That's a really good one to look at. If you're going looking at houses, get that checklist and tick it off. What to look for. Mortgage and stamp duty calculators. Work out the cost of those if you're not a first-time buyer. Money Helper guidance on home buying and Rightmove buyer's guide. And then just a quick highlight on the help and support you've got with the ICE Benevolent Fund. And that's everything in a nutshell.
Amazing. Thank you, Nadine. I appreciate that. Was a huge amount of information to go through. Thank you very much. You did a brilliant job. Just a couple of quick questions.
Of course.
You mentioned a website for buying in Scotland and Northern Ireland.
Yeah.
Are you able just to remind us what that was, please?
Let's whip back to that. Was it this one? Sorry, let me just... I don't think it's this one. 1 minute.
I think it was right near the
beginning. Did I just say it in my script?
You might have done, yeah.
Yeah,
what we can do is we'll pop it in the email when we send out the recording of today's webinar.
I'll have to just find it. I think it was just in the script, so I'll find that as well.
No problem at all. And then someone else has asked, I have 2 very different credit scores from Experian and ClearScore. Which one is more accurate?
They're both accurate. So there are 3 credit reference companies in the UK. It is important to know your score across all 3 because they do all score a little bit differently. Because you don't know as the everyday person what combination of those credit reports that a product service provider, as in a mortgage company, a lender, is going to check. So for example, if you went for a sofa at DFS on credit, they might only check your TransUnion one, your Credit Karma one. If you went for a fridge freezer at Currys, they might check TransUnion and Equifax. A mortgage company might check your score across all 3. So it's so important that you know your score across all three, because they will check a combination of those three. Usually mortgage companies, especially bigger banks and building societies, will check all three of your scores, because like I said, they do score a little bit differently and have sometimes different information on there. There's not one more accurate than the other. They're all accurate in their own way, if you know what I mean.
Excellent. That's great. Thank you very much. Just one final question. If I have a little bit of spare money each month, am I best off overpaying my mortgage or popping some of that money into my pension?
It's entirely up to you. I think it depends how far out you are from your pension age. It depends how what's your priorities at the moment. So, you know, there are benefits. So if your interest rate is high, that's something to ask on your mortgage. If your interest rate is low, then you might get better returns putting your money into a pension. However, if your interest rate is high, you may wish to pay money off your mortgage. Your pension benefits, you know, with workplace pensions in particular, you may get employer matching contributions, and this is essentially free money. And if you're not making the most of this, then you may wish to put more into your pension. But it is about the timeline. So if you're younger, then pension investing has more time to grow due to the compound interest. If you're older, nearing retirement, you may find overpaying your mortgage provides peace of mind, because you want to get into your retirement not having the overheads that you've got now. So you want to bring down those outgoings, so that when your pension income comes in, which is going to be greatly reduced, it doesn't matter because you've not got the big overheads. So it is a timing sort of thing, and you've just got to kind of work out kind of the pros and cons of interest rates. And you've got to remember that you can't access your workplace or private pensions until age 55, and it will be 57 in 2028. So you've just got to work out the timeline on that, whether it's right for you. You want to be mortgage free in more of the shorter to medium term, or it's something that you can keep on the long term kind of radar.